So now continuing towards the March-June 2023 exam, question number 3 of March-June 2023 exam. That is the question number 3, the last question of this exam. The name of this question is Crawley and Corporation. Crawley and Corporation. The introduction says that, let me reduce the screen size. It is 1st of July 2015 and you are a manager in the audit department of Crawley and Corporation. This is the name of our firm and I'm a manager within this firm. You have recently been assigned to the audit of Violet Corporation, a company which produces catering supplies such as sandwiches and cakes, which are sold to cafes, restaurants. All right, these are whatever we produce is sold further on to restaurants and cafes, and the restaurants sell it further on to the actual customers. Its financial year ended on 31st of March 2015. This is the year end of this company. You have been also asked to assist with reviewing the auditor's report for a different audit line. We have already covered up this section within our syllabus regarding the auditor's report. There are two types of questions that the examiner can ask regarding the auditor's report. The first type of question is the same as in AA exam or F8 exam, which was we had to identify and state what was the materiality related to the situation, what would be the opinion in our answer, and all the other things related. How would we situate, how would we write down the opinion with our exam related to the scenario itself. The second type of question that the examiner can ask, and this is the most type of question that the examiner asks within the exam. The question is, the examiner will have already given us a part of the audit report and he will say that criticize this report. What is wrong with this report? So let's see what type of question the examiner has asked within this scenario. Branson Corporation, which is a listed entity operating in pharmaceutical industry with a financial year ending of 31st of May 2015. Great. Branson Corporation is a part of a multinational group and its parent company is Grantham Corporation. Your firm audits Grantham Corporation, Grantham Group, and all the components of the group as well. Basically, this is now a different sort of situation and this is a different type of question. So what I'm expecting to see within the requirements is almost two different types of questions, each related with two different companies. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Let's directly move towards the exhibits. Number 1 is Violet Corporation and number 2 again is Branson Corporation. Obviously, we have been given two different companies and the questions again will be from two different companies. So instead of moving towards the requirement within this exam software, I will be moving towards my own software in which I have copied and pasted all the requirements and all the exhibit. This is exhibit number 1. And this is the exhibit number 2. And these are the requirements from the exam. So let's read the requirements for question number 1. What does the requirement say? It's that using exhibit 1, part A1. What does it say? Discuss and justify whether two internal controls matters should be included in your communication to those charged with governance and management of Violet Corporation in respect of deficiencies in internal controls. When we were studying the topic from the book or from my notes that I provided to all of you regarding the auditor's report, I will directly come towards the notes. I will explain each of these points regarding this question. What I'm trying to say is this, that when we studied the section of auditor's report, within auditor's report, there is a very small topic within the book and within my notes that I shared to you. What matters should be communicated? Matters to be communicated to those charged with governance. What matters should be communicated to those charged with governance, or management. Basically, the auditor, when they are auditing a company and when they are at the near towards the end of the audit, they are about to issue the auditor's report, they usually send a management letter, or otherwise known as the board letter, to the company. In this board letter or management letter, we present to the company, these are the significant areas that we identified. These are the deficiencies in the internal control systems which we have identified, and you should correct these. Now, keep in mind that this specific area, what matters should be communicated at the end of the audit to those charged with governance or to the management. What is the difference between those charged with governance and management? Those charged with governance means the board itself, the audit committee, the board of directors, and management means the people who are running the company, like the CFO, the CEO, the directors of different departments. What are the matters to be communicated to each of these parties? Now, basically, within this syllabus area, within this course, There are two types of matters which have to be communicated to those charged with governance. Matters relating to financial statements themselves, things that have been recorded wrong, things that should be corrected. There are material misstatements within the financial statements. Those are the first type of matters that have to be communicated. The other type of matter which have to be communicated are the deficiencies within the internal controls. You used to study these when you were studying F8. The internal control deficiencies. You identify that there are shortcomings within the internal controls. These can be done a lot better. The internal controls are not correct. No one is authorizing something. No one is checking something. No one is reviewing something. There is not proper authorization before the check is presented to the supplier. Within these conditions, there were internal control deficiencies. Now, the main key thing here to realize, in the case of internal controls, what matters of internal control deficiencies should be referred to those charged with governance or management? What should be communicated to those charged with management? Obviously, when an auditor is testing internal control system, there are many different deficiencies that we identify. When you will go to the practical life and work in an audit firm, you will analyze that auditors identify many different misstatements. They don't identify one or two different deficiencies within the internal controls. Many different deficiencies have been identified within the internal controls, but the auditor does not have enough time to properly recommend regarding each of the deficiency, to properly communicate each of the matter to those charged with governance. Obviously, people upon the board, they have to run the company. They have to give direction to the company. They are already involved in running a company. The management, CFO, CEO, they are also involved in running the company. They don't have enough time to look at each and everything if we present it in so much detail, which is why we cannot communicate every single thing. We cannot write down, this is also a deficiency, this is also a deficiency. We have identified 100 different deficiencies and give them a 100-page document, and upon each page there is a separate deficiency given and a control against it given. We can't do that. What we can do is we identify all the deficiencies, but on the board level, on the management level, we only communicate those deficiencies within the internal controls which are material, or in other words, which would create material misstatements in the financial statements. For example, there is no proper authorization being done, proper authorization of a check, CHECQUE, proper authorization of a check being performed before it is given to a supplier. A junior member of the team prepares a check and takes it and gives it to the supplier. There is no segregation of duties here. The junior member prepares it, writes down the amount that he needs to give it to the supplier, approves it himself, and then goes and gives it to the supplier. Now there is a lot of reasoning here, or there is a lot more chances of a fraud occurring. What if this junior member writes a check, approves it, and submits it into his own bank account? What if the amount he writes upon the check is not appropriate? If we write down a lower amount for the supplier, a reputation with the supplier will be affected. Whereas if we write more amount to the supplier, he will take the money and he won't return it. So basically, if an internal control deficiency has a higher risk that it will create fraud, or it will create a material misstatement within the financial statements above the materiality that we have understood. How do we set that materiality in question number 1? If these internal controls would create fraudulent chances, or at the same time material misstatements to the financial statements, these internal control deficiencies should be reported to those charged with governance, to the higher up people. Now, for example, another internal control deficiency: what if we bought inventory, we checked the inventory, whether the correct amount, whether the correct inventory has been received, whether the quality is correct, everything is correct, but at the end we did not store the inventory at the correct level, at the correct warehouse. The warehouse has changed. For example, we have a warehouse in one location and we have a warehouse in the second location. We had to store this amount of inventory, the new inventory that we received at the second warehouse, but due to deficiencies within the internal control, we stored this inventory within the first warehouse. Now, is this internal control deficiency going to lead to a material misstatement within the financial statements? No. Whether you put inventory within the first warehouse or the second warehouse, it will still be shown within the financial statements. So there are less chances of material inventory being overstated or understated. There is a less chance of occurring. You had to store the inventory in the first warehouse, but due to internal control deficiencies, the inventory was stored in the wrong warehouse, which was the secondary warehouse. Both the warehouses are owned by you. You are the ones who own these warehouses. So whatever the case is, even if you store this inventory in the first warehouse or the second warehouse, still it will be recorded within the financial statements. So this internal control deficiency will not lead to a material misstatement within the financial statement. At the same time, is there a high chance that a fraud could occur because of this? How? This is also your warehouse. This is also your warehouse. Whether you transfer this inventory to this warehouse, you still have controls over it. No one can steal here. No one can steal the inventory from this warehouse because you have security guards because you have guards or security companies watching over the warehouse 24/7. So whatever the case is, there is no fraud of occurring. There is no fraudulent activity that would happen because of this internal control deficiency. And at the same time, there is no reason to believe that this internal control deficiency could lead to a material misstatement in the future. Now, because of this internal control deficiency that we have identified, it is not material to the financial statements. So internal control deficiencies become material to the financial statements because of two reasons. If an internal control deficiency could lead to a material misstatement, material misstatement in the financial statements in future, this deficiency should be reported to those charged with governance and to management. At the same time, if a deficiency within internal control system has a risk that it could lead to a fraudulent activity, then again it should be disclosed to those charged with governance or to the management. If I come towards the book where this topic has been stated on page number 418, this is the second last topic of your AAA exam, the AAA book. If I come towards it, this is where we study about it. You can also study about this. Basically, to remember is this: it is based upon the auditor's judgment whether they should disclose something to those charged with management or not, and to those charged with governance or management or not. It is based upon the auditor's judgment themselves. It is the auditor's decision whether they want to disclose something or not. And using this decision, obviously, this decision is very difficult to take. Hence, in order to solve these type of questions within the exam, remember two things. If an internal control deficiency will lead to a future material misstatement within the financial statements, you need to disclose it. If an internal control deficiency could lead to a fraudulent activity in the future, you need to disclose it. Because these types of deficiencies in the internal control systems are more useful to the management. They need to take action upon these deficiencies. Apologies, I had an internet disruption because of which there was some time of a breakup between the lecture. But coming towards what I was trying to say before the video ended, before this lecture ended, I was trying to say that two types of deficiencies within internal control systems have to be reported to the management. Those which will lead to a material misstatement within the financial statement, and the second type, those that could lead to a fraudulent activity occurring within the company in the future. These two types of deficiencies should be reported because these two types of deficiencies are the number one priority which should be fixed by the management. And against these two types of internal control deficiency, we as an auditor also have to provide a recommendation how these internal controls should be made, what types of internal control deficiencies, what are the recommendations that we give you, what sort of internal controls should you have within your company. The same that we used to do within F8. There is no difference against that. In F8 or AAA, what was the type of question that was asked within the exam? The type of question was, you used to identify the internal control deficiency if something is not being done correctly, and against that we used to provide a recommendation how the internal controls should be made. Same is the case here. But within this question, we don't have to make a deficiency and provide a recommendation against it. We just need to tell the management, we just need to tell the examiner whether something has to be reported to the management or not. And if it has to be reported to the management, why? Now we will justify our reasoning, because the examiner has stated it. Justify why you will have to report these to the management, these internal control deficiencies to the management or those charged with governance. Now obviously, in the case of justification, we will explain whether this deficiency would lead to a future material misstatement within the financial statement, or it will lead to a fraudulent activity occurring in the future. So again, this should have been the case. This is how we are going to solve the question. Now, the question clearly states that use only the exhibit 1 to perform this question, to do this question. The examiner has stated discuss and justify. Now, in order to do this, first I will try to explain what is happening within the scenario. I will explain it within my own words. That is how I discuss. And coming towards the justification, obviously the examiner is asking a give me a reason why you think that this deficiency should be reported to the management. Now, obviously, giving a reason, I will change my answer or direct my answer towards either of these two reasons that we have studied here. Either one deficiency would lead to a material misstatement in the future in the financial statements, or either it will lead to a fraudulent activity occurring. Now, whatever is the case, I will justify using these two reasons. Now, coming towards the question itself, this is the exhibit number 1. This is the portion that leads to this question, that only relates with this question. If we study this, if we read this, internal control matters. The audit engagement partner has asked you to evaluate 2 matters. Now, what are the marks of this question? First of all, the total marks, 5 marks. So this means 2.5 marks for each of the issues. There are 2 issues, and we have to justify and discuss against these 2 issues, whether it should be included within the discussion with the board and the management or not. The audit engagement partner has asked you to evaluate 2 matters which arose during the audit and to consider the communication of these issues to management and those charged with governance of Wallet Corporation in accordance with ISA 265, communicating deficiencies in internal controls to those charged with governance and management. Now, obviously, first of all, before solving this question, before reading the matters itself, these are the 2 matters related to this, the number 1 matter and the number 2 matter. Before writing about this, I will go towards my answer and write an introductory paragraph within the word. I will write down an introductory paragraph here. What would be the introductory paragraph be? First of all, let's enter part A and 1. Let's bold it. Obviously, I'll explain what matters should be disclosed to the management or to those charged with governance. The internal control deficiencies are based upon the auditor's judgment themselves, and I will further explain the matters that could lead to a material misstatement occurring in the future, or they could lead to a fraudulent behavior or fraudulent activity occurring within the company. These are the matters to be disclosed with the management, but again, it is upon the auditor's judgment. This is what I will mention in the introduction of this question itself. In accordance with ISAs, I do not need to mention the specific ISA number. In accordance with ISAs, the auditor, it is based upon the auditor's judgment. It is based upon the auditor's judgment whether an internal control deficiency should be disclosed to those charged with governance or management. Specifically, a deficiency should be disclosed, should be reported to those charged with governance, or management if it would lead to a material misstatement within the financial statements or to a fraudulent activity in future. That's it. That would only be the introductory paragraph for myself. Now I will go ahead towards the scenario itself and start reading the issues and explain about them. Obviously, I will use the headings and paragraph format to write my answer. The first heading, obviously, for me would be new payroll system. That's it. That is the heading that I would state. So I'll write down new payroll system and whether this matter should be disclosed to those charged with governance or not. Now, I do not need to bold it, but what I would do is underline it. Where is the underlining one? Right. I would underline it because if I bold it, there would be a confusion that whether this is a new question that we have started or not. So this is the heading that I would give. Now coming towards the question itself, I'm going to read this point and identify what does it lead to. Does it lead to a material misstatement in the future, or does it lead to a fraudulent activity occurring? Prior to September 2014, the company had used two different payroll systems. All right, obviously there are systems within the company. Nowadays, there are technological systems or AI systems or computer systems that automatically records what is the amount of salary to be paid to an employee. The name of my employee, the age of my employee, his personal information, each and everything will be stored within that system. But before this date, we used two different payroll systems. All right, one for workers who are paid hourly, and a separate system for employees on a fixed salary. Like financial reporting people, the people who work in the finance department usually have a fixed salary for each month, like $3,000, $4,000, or £4,000 or £6,000, like this. So for these employees who had a fixed amount of salary per month, we were using a different system. The name of the employees, the date of the employees, the date of the employment, the date of birth, their age, their social security number, each and everything was stored within that system. That system used to calculate their salaries and used to pay those salaries to those employees. All right, and I had another system for the employees who are paid hourly. Now their hourly rate, the number of hours they have worked, their age, their date of employment, all of their name, their social security number, all of this information was stored in that system. That system automatically used to calculate the number of hours that the employee has worked and their total salary for the month based on the number of hours they have worked. So I had two different systems before this date. In September 2014, in this month, a new payroll system was introduced which integrates and enhances the two systems. All right, this means that from this month onwards, I bought a new system. Now, instead of having two different systems for both of two different types of employees, I only had one system. And this system had the capability to record all the data for each of the employees. This system was able to calculate the hourly rate, the total salary for the people who are paid hourly, and the fixed salary. It was an advanced system. So instead of now using two systems, I am going to use one system from this date onwards. Great. Audit procedures indicated. Now, remember this. We used to study this within F8, within AA, and I'm going to revise it to you. Whenever a company is introducing a new system, for example, let's only talk about the payroll for now. I was using a payroll system before, which was given to me by, let's say, Oracle gave me the payroll system first. Up till 31st of March, I was using the system which was provided by Oracle. After this state, SAP contacted me. SAP is an accounting accounting software company, because they contacted me and told me that now we would like to provide you the payroll software and you would pay us for that, whatever the case is. But they are going to provide us the payroll system. And after this date, we were going to use the SAP's payroll system. Now, whenever a company is transferring from one system to another, it is required or it is recommended that instead of directly just putting all the information from this system to this system, don't do that. And start using this system from this day onwards, don't do that. For the next at least 1 or 2 years, run both of these systems simultaneously to identify whether the new system has any kind of errors or not. This is a recommendation from the IFRS, IAS bodies or different types of bodies. And this is a generally accepted practice that you should do. For example, let me give you an example. If you are going to install, let's say, a new printer in your home, you would not just at the day you buy a new printer, you bring it to your home and you start using it. At that exact moment, are you going to pick up your old printer and throw it out of your house? No. You would first check whether the new printer has any kind of error. Because if there is any error in your new printer that you have just bought and you have thrown out the old printer, how are you going to print new things? No, you have to take appropriate steps for that. Understand? If I buy a new mouse, let's say I have this mouse right now working with this computer, working with this laptop. If I buy a new mouse today and bring it to my house, before using the new mouse, I'm going to throw this mouse out of my home because I don't need it anymore. What if the new mouse does not work? Or what if the new mouse has errors in them? Then I'm going to face issues, right? Same is the case with the systems that a company uses. Whatever system, whether it was a PPE system, a fixed asset system, a payroll system, an internal control system, an MIS system, or EXI system, or EIS system, executive information system, or expert system, whatever system you are using, remember this, every company must do this. when they are going to use a new system, first both of the systems for at least 1 year should be run in parallel to each other. What this means is that for the next 1 year, I am going to calculate the salary for each of the employee using this system as well and using this system as well to check whether the new system has any kind of error or not. Because if in the next 1 year, if I identify any type of error within SAP, I would correct it. I would identify that error and correct that error. So at the time after 1 year, when I stop using this system, the new system that I bought is completely free of any kind of mistakes. So because of this reason, now if a company, now assume this, these systems calculate the total cost of payroll that is linked with the statement of profit or loss. Great. Now, if I directly went towards the new system, if I directly started using the new system, I have not run both the systems simultaneously with each other for at least 1 year. I have not checked whether this new system has any kind of errors or not. Now, those errors would not be identified. Those errorly calculated financial statements figure would be stated within the statement of profit or loss. So there is now a chance that there would be material misstatements within the figures that are reported in the statement of profit or loss, the payroll expense that is calculated within the statement of profit or loss, beginning from the new system, because we have not even tested it. So if we have not tested something, we just started using it, so there is a chance there is some kind of an error within this system. This system may not be able to calculate the correct figure that should be reported within profit or loss. So now you are stating that there is a high chance that material misstatements within the financial statement or specifically within profit or loss would occur in the future. So now because of this, this is an internal control deficiency in itself, that we did not run simultaneously both the systems together. And this deficiency could lead to a material misstatement in the future as well. So because of this reason, this deficiency should be reported to those charged with governance. But we have not read the full situation as of now. We have not read the full question, the full scenario as of now. Maybe we will be able to identify other issues as well. Now let's read. Audit procedures indicated that when the data was migrated to the new system, some problems occurred with data corruption and duplication. The amount was duplicated, the people were duplicated. This means that there might be a reason that two times salary would be paid to a same employee. I would be paid 2 times salary. If I am getting paid $1,000 per month, this means that I might be paid $2,000 per month because my name was entered twice. And some employees might not be paid a salary at all because there was data corruption. Further audit procedures indicated that this did not result in a material misstatement within the financial statements in the current financial statements. We have identified that there is no error within the current financial statements. But what if this issue, yes, there is no material misstatement within the current financial statements, but you have not tested it. You have not run it simultaneously with the old system. You have not identified whether there is any kind of error. What if you have not identified any type of error, and that error, it has not led to a material misstatement in the current financial statement, but in the future it might lead to a material misstatement. So because of this reason, this could lead to a material misstatement in the future. And because of that, I'm going to report this issue to those charged with governance, that this is a significant internal control deficiency and you should work upon it. So coming towards my answer, I'm simply going to write the management started. Now, first of all, I will discuss this issue. I will not directly go towards the question itself, towards the answer itself. Reason being, the examiner has stated, first discuss it, then justify it. The management started using a new system before the management used old two systems separately for hourly paid employees, hourly paid and fixed salaried employees, hourly paid and fixed salaried employees. It is common that because I can also write it here that when you are transferring all the data from two systems to one system, there are a lot of complexity involved and you might get errors while transferring the data in itself. It is common that while transferring data from two systems to one new system, data complexity may occur, or the new system might not be able to properly incorporate the data at first. Hence, whenever a new system is being installed, it should be run simultaneously with the old system for at least 1 year to be able to identify and correct any errors within the new system. And also to test whether it is working appropriately, whether it is generating figures and working appropriately. So this would be my introductory discussion that this should happen. But now I will move towards why I should disclose it to the management of those chartered governance, because this issue can lead to a material misstatement in the future. Because of data corruption and duplication, there are chances of duplicate pays to same employee and no pay to some employees. Additionally, because of no testing performed of new system, there are also chances that errors within new system would not have been identified, which can lead to material misstatements within the financial statements. Now, obviously, within the scenario, it has been mentioned that no material misstatement occurred in the current year. So I have to mention that as well. Although no material misstatement has occurred in the current year, still there is a highly likely chance of material misstatements occurring from errors within the new system, which have not been identified. Hence, because of these reasons, because of the above reasons, this deficiency in internal control should be presented to those charged with governance and management, an appropriate recommendation given against, and appropriate recommendations given against. That's it. So basically what I'm saying is the knowledge of F8 combined with the knowledge of AAA, why this deficiency should be disclosed to the management. And at the end, I'm just only saying that appropriate recommendation should be given against it. Now, obviously, I don't have to give any kind of recommendation against this internal control. That is not my job. No marks will be given to me because in the question itself, the examiner has not stated that provide appropriate recommendations. If the examiner would have stated that give me appropriate recommendations, then I would write down the recommendations. But for now, the examiner has not asked me to give any kind of recommendations. So I'm not going to give any type of recommendations. Coming towards the second deficiency itself, let's first give the heading. What would be the heading? Again, it would be same as the scenario. Marketing director. Okay. The marketing director itself. Now, coming towards this deficiency within the scenario, it states that the marketing director left Violet Corporation in March 2015. Okay, this is when the marketing director left. When testing capital expenditure, one of the audit team found that in the week before she left employment, before the marketing director left employment, the marketing director had taken delivery of a new laptop computer. So basically, she bought a new laptop computer, okay, which remains in her possession. And she still owns, she still, after even leaving the company, she still has the laptop. Okay. Now, what is the issue here? No supporting documentation could be found for this purchase, but the financial controller has approved the capital expenditure. The laptop is included as an asset in the non-current asset register. Oh, so basically, by understanding this situation itself, what I am identifying is that the company, this means the actual company, bought the laptop for the marketing director at the same time. Now, when she left the employment, if she has left the employment, the company owns the laptop. The marketing director does not own the laptop. She does not own the laptop. This means that when leaving the company, she should have returned the laptop to the company itself, but she has not done it. Now, this might raise to some type of issues. First of all, there is an internal control deficiency by the financial controller who has approved the capital expenditure and has still recorded it in the non-current asset register. First of all, if this laptop was bought specifically for the marketing director herself, and according to the company policy, whenever something is bought for the marketing directors or any of the employees, they can keep it. The company does not own it. This means that you should not record it in your non-current asset register, because if you are recording something in the non-current asset register, this means that it is being recorded within financial statement under IAS 16 property, plant and equipment. So you should not record it because the marketing director owns it. But if in case you own this laptop, the company owns this laptop, there is a deficiency that why this financial controller has approved it to be recorded within the financial statements, and the financial controller knows that this laptop is still with the marketing director herself. Why? Now the question here is, what if that laptop still has access to the company's confidential information and the marketing director uses that confidential information for her own use? What if that laptop still have access to the company's funds and the marketing director performs a theft of the company's cash flows, the company's assets? So this internal control deficiency should again be, and what is the internal control deficiency? The internal control deficiency is not that the marketing director might perform the theft of the company's cash flows because she might still have access to the company's funds on the laptop. The laptop does not have the systems removed before giving her the laptop to take her to take it to her own home. But the fact that the financial controller knows about this and he has not taken any kind of action against it, this is the internal control deficiency. All right, so we need to discuss about this as well. Coming towards this, first of all, again I will provide an introductory discussion regarding this issue. The marketing director was given a laptop by the company. By what is the name of the company? We should use the name of the company itself. The name of the company is Violet Corporation. By Violet Corporation before ending her employment, and this was approved by the financial controller and recorded within this within the asset register. All right, great. After leaving the employment, as the company owns the laptop, and had paid for the laptop, should have been given back to the company by the marketing director, and this should have been appropriately communicated with the marketing director, with the director, by the financial controller after she left the company. Basically, we are developing our own understanding that After the marketing director would have left the company, the financial director knew that we have bought a laptop for her. So he should have been the one who told her that you need to give us back the laptop because you are leaving the company. Now, we can also raise an integrity issue upon the financial controller, that he is not like following the integrity and not being straightforward and honest. He should have been following integrity and should have been honest and taken back the laptop. This also raises a question about the integrity of the financial controller, as he should have communicated this and taken action to get the laptop back from the financial controller. Now, obviously, single laptop will not be material to the financial statement. So we should also state the fact that alone this laptop would not be material to the financial statement. But if that laptop still has access to the company's funds, the company's own confidential information, it might be used by the marketing director. So this is what we need to state. Although the laptop alone will be immaterial to the financial statements, but still, as it was bought by the company, it still may have access to companies confidential information and companies funds, which the marketing director may use or perform a theft of the funds. Hence, this internal control deficiency would lead to a fraudulent, might lead to, not would, we are not sure of it, might lead to this internal control deficiency might lead to a fraudulent activity in the future. Hence, this deficiency and the fact that the laptop is still with the marketing director and that no action was taken by the financial controller should all be reported to the management and those charged with governance So this is going to be my answer for this specific question itself. Basically, what I'm saying is that all the three issues should be reported. The fact that the financial controller did not take an action, this is an internal control deficiency. The fact that the financial control has not taken any kind of investigation or has not taken any kind of action against the fact, this leads to his integrity questioning, the question against his integrity. This second issue should also be disclosed to those charged with governance or management, and the fact that the laptop is still with the marketing director should also be disclosed to those charged with governance and management, so they can take appropriate action as they want. And also, appropriate safeguard and appropriate recommendations should be also provided against this. That's all I'm going to state for this question. Obviously, 2.5 marks for this. Let's say 2 marks for this, 2 marks for this, and 0.5 marks for this introduction. And my marks are full, complete. I don't need to write anything else. Coming forwards, if I come towards the question number 2, what does the question number 2 state? The question number 2 is specifically for 7 marks. It states that Using the file note prepared by the audit supervisor, recommend the matters to be included in your report to those charged with governance of Violet Corporation and explain the reason for their inclusion. Now, when I was explaining what are the matters that should be disclosed to those charged with governance and management, I stated that there are two types of issues which are stated to those charged with governance. The number one is the deficiencies in the internal control. They have their own understanding, either they are material or they would lead to fraudulent activity in the future. And the number second type of issues that could be communicated to those charged with governance are all the issues related with the financial statements and what happened during the audit. Like if you face difficulties, those matters should also be disclosed to those charged with governance. During audit matters and matters relating to financial statements, these should also be disclosed to those charged with governance. Now, understanding this is quite simple. If I take you towards the book itself, page number 416, where this topic actually stated matters to be communicated to those charged with governance other than the internal control deficiencies are right here. Significant findings from the audit, like what are your understandings during the audit, any kind of difficulties that we faced during the audit, significant matters during the audit that were discussed with management and the management has not responded appropriately to those issues. Written representations, if we are demanding any type of written representations and the management, not those charged with governance, and the management are not providing it, they should also be disclosed to those charged with governance. But the main fact is that these are the things that we always disclose to those charged with governance. If we had any kind of delays in obtaining any information, what information was delayed, it is disclosed to those charged with governance at the end of the audit. Reasonable time, like unreasonable brief time within which the audit has to be completed. If we have been given a low amount of time, a small amount of time to complete the audit, like 2 or 3 months is a very low time to complete an audit. It normally takes around 4 to 5 months to complete an audit. So that would hinder the quality in the future, and if it is hindering the quality, you should disclose this fact to those charged with governance. These were the type of issues that have to be disclosed. But remember, always look at the scenario itself. If you are finding something that you think that it is not right, it should be disclosed to those charged with governance. It is a simple thing. In practical life, we always follow the ISAs, but within the exam, use the scenario, just like we use the scenario to prepare procedures, using the scenario to prepare procedures, just like that. If you find something within the scenario that is not being done appropriately by the management or by us, or we faced any kind of difficulties, report that issue to those charged with governance. Now this issue is specifically for 7 marks itself. Using the file note prepared by the audits and matters to be included in those charged with governance of Violet Corporation, and we also have to explain the reason why they should be explaining. We have a total of 7 marks. Now, obviously, this does not mean that we will need to write 7 appropriate points for it. Like we don't need to identify 7 things that should be reported to those charged with governance. No. Under each of the things that we identify, explanation would be required, like why this is important, why not. The more significant thing that we identify, this means that it will be given more marks to it. Some of the issues that we identify might have 2 marks. Some of the issues we identify might have 3 marks within the exam. But we'll keep in our mind that we will be given 2 marks for each of the issue, because we are identifying it and then explaining that why it should be included. A detailed explanation where it is required, we would need to be giving 3 marks. The examiner will most probably give us 3 marks for that. Coming towards the scenario, the exhibit 2 relating to this, the exhibit number 1 relating to this scenario is this one. It says that file note prepared by the audit supervisor. In addition, the audit engagement partner has asked you to review a file note prepared by the audit supervisor and consider the matters to be reported in accordance with ISA 260, communication with those charged with governance. Now, these are the matters again. Obviously, we are not simply going to go ahead and write upon these issues one by one. First of all, we need to give an introduction that what matters are to be reported, part A, and this is number 2. So we will bold it, and I don't need to write anything again. I will just copy the first part and change a bit, because in the first part we talked about internal controls. In the second thing, we will talk about again the in accordance with, kindly ignore the spelling mistakes. In accordance with ISAs, it is based upon the auditor's judgment whether a matter should be disclosed, whether a matter should be disclosed with those charged with governance I do not need to include management here because the examiner has not stated it. That's it. That's all I need to write down. Now coming towards the issue itself. The number one issue, availability of information and manual journal. So these are two separate informations given to us. The information provided by Wallet Corporation's finance director at the start of the final audit did not support a number of material balances in the draft financial statements. As a result, a number of requests for additional information had to be made, which prolonged the duration of the audit. So basically, this led to us having a lot of free time. We were not able to work productively, and again, this is an issue that we face, that the finance director did not give us the appropriate things that we required, and we need to tell those charged with governance that this has occurred during the audit, so make sure this does not occur again. We need to have access to appropriate information to productively audit all of the information. If we are wasting time against information that is not required, this would create quality matters for the audit. So again, this is the first issue that we need to explain. So delay of information, I think this should be the appropriate heading for it. Again, I would just underline it and not bold it. Coming towards my answer, at the start of audit, the information provided by the finance director did not support the reasoning for material balances in financial statements. This matter should be reported to those charged with governance, as they should know whether, if the audit is delayed, the reason for the delay was not with the auditors, rather the information from the finance director. Additionally, this information should also be given to those charged with governance, as this raises the question on integrity of the finance director, and the fact that auditors should have access to appropriate information in order to complete the audit within the deadline. That's it. That's all I need to include here. So this was the first issue that we faced, and we don't need to provide a detailed explanation. This is more than enough here. We don't need to add two paragraphs. In the first deficiency case of question, I was adding two paragraphs because each of the issues had at least 2.5 marks. But here we have so many different issues and only 7 marks, so I'm not going to just simply go ahead and write down so much just for one issue. This is more than enough. This is like giving me 2 appropriate points here. So I would guess that this is going to give me 2 marks. Now, going towards the second issue, this second paragraph. Even when the additional information had been provided, the audit team found it difficult to agree the draft financial statements to the trial balance. All right. We must know how the financial statements are made in the practical life, or what you have studied within F7 and F3 so long and so forth, and in SBR. First of all, T accounts are made. The balances from these T accounts are closed, and these are transferred to the trial balance. A detailed balance like this account name, let's suppose receivable had a closing balance, so we will write down receivables had a balances of this, payable had a balances of this. This is how trial balance is made, and then from the trial balance the financial statements are made. So basically what the auditors are trying to say, that if in the financial statement the payable balance was 100, in the trial balance it was 90, so we were not able to match the trial balance with the financial statements themselves. And the general ledger, oh, we were not able to match the draft financial statement to the trial balance. This means that the financial statement figure, we were not able to match it with the TB, the trial balance, and from the TB, we were not able to match it with the trial balance. Everything was not matching. And the general ledger, because of several manual general entries which had been made. This means that the company automatically, instead of not only using the software, not only getting it authorized from the senior people, they directly write an entry within the financial statements, and this is an internal control deficiency. Again, you are not taking proper authorization for recording something, you are manually entering something into Excel. In the practical life, this is not how it is done. You first of all have to take authorization. This is an entry that I have to record. We have studied this within FA. Whatever entry you are recording within the financial statements, you need to properly authorize them from a senior person, and through the software it is then recognized within the financial statements. Whereas you just record them on your own without taking appropriate authorization, this could lead to fraudulent activities being made, fraudulent journal entries being made within the financial statements. Significant additional audit testing was undertaken as a result. Similar problems in confirming manual journal entries had been noted in the previous year and discussed with the audit committee. So we have discussed this issue previously as well. Whenever an issue has been discussed previously, we always have to look whether that issue has been resolved or not. We have already discussed this issue with the audit committee, those charged with governance again. And if an issue has been discussed previously, we need to look into that issue, whether it has been resolved in the current year. And if it has been resolved, we tell the audit committee the issue that was previously there is not there anymore. But this is the case that when the issue has been discussed, you have not taken even those charged with governance have not taken appropriate action against it. This we need to again tell them that this would lead to a material misstatement within the financial statements and a fraudulent activity at the same time. So this is an internal control deficiency. Let me give a heading of deficiency. Underline this and move towards my answer. The fact that manual journal entries, I just need to explain it. The fact that manual journal entries are booked in the financial statements should be disclosed to those charged with governance. Those charged with governance should be made aware of the fact those charged with governance should be made aware of the fact that entries cannot be recorded manually. Rather, appropriate authorization is performed before any entries. And if manual entries are being done, manual entries are being performed, this could lead to fraudulent activities, fraudulent entries being recorded, which would not be identifiable as these were not reviewed or approved. Hence, the audit committee should be made aware of the fact that the same issue was also reported in the previous period to them, while no appropriate action has been taken against this deficiency in internal control. So this is going to be my answer for the deficiency. If I come forwards, let's read this next issue. The next issue relates with property valuation. Great. Violet Corporation currently adopts an accounting policy of recognizing properties at cost. Obviously, IS 16 gives us two types of methods that we can use to record any kind of property subsequent measurement. Either we can record any kind of property on cost. This means that never revalue the property, just depreciate it. That's it. That's all you do. Under IS 16, just depreciate the property over the number of years you are using, or on the reducing balance basis. The principal cost of actually acquiring that asset does not change. This means the asset never comes to its market value. Great. This is what we used to did up till now. During the audit of non-current assets, the audit team was informed that the company is considering a change of accounting policy in the next financial year so that properties would be recognized at fair value from 1st of August 2015. So basically what the company is doing, that up till now they were using the accounting policy. This is a change in accounting policy. Remember that under IAS 10, subsequent under IAS 8, changes in accounting policies, estimates and errors. If an estimate is being changed, this means that you need to account for it prospectively from now and onwards. You do not need to change the previous financial statements. But if an accounting policy is being changed, this means that you need to account for it retrospectively. So this is a complex issue because the management might not understand how this would affect their efforts, how this is going to affect them, because now they need to change the financial statements that were prepared previously. A prospective effect should have been taken. So if you are introducing this new policy, we need to disclose this to those charged with governance, that the management is considering changing the policy. You should be aware of this fact, because this will take a lot of cost, a lot of understanding, hard work to change the prospective figures of the financial statements as well. Now, this is the first issue that we will have to discuss with the management, that will have a retrospective effect. But what is the common word? This is going to have a significant impact upon the financial statement. Instead of just saying that this is going to have a retrospective effect, mentioning the accounting standard here, I can also state that in addition to a retrospective effect, it is going to have a significant impact upon the financial statements when all the properties are going to be remeasured at their fair value, at their market value. The value within the financial statements of IAS 16 property is going to go up very much high, like significantly above materiality. This will be a very high change in the materiality. So there will be a significant impact upon the financial statements as well. And whenever there is a significant impact upon the financial statements, the matters is also to be disclosed with the management. Now we can also let the management know, because you are changing your policy, the way we audited up till now, because your properties were based on cost, the market value had never changed. So our auditing strategy was different. In the next year, when you implement the change, we will do a separate type of audit. Like, this means that our strategy for actually auditing now the property which are at fair value, because now we will need to determine whether the fair value has been considered under IFRS 13. We will need new type of information from the management. This should also be told to those charged with governance at the same time. So coming towards my answer, I'll give a heading of new policy and underline this and come towards the answer. I'll write down, the management is implementing a new policy for the properties, and these properties would now be recorded at cost, at their fair value, rather than cost. As this is a change in an accounting policy, this means that the financial statements will have a retrospective effect under IAS 8, and this would be a significant impact to the financial statements. Additionally, we should also communicate to those charged. Hence, this, first of all, I need to mention that this matter itself, that the management is considering this policy change, should be disclosed to, or should be reported to those charged with governance. Hence, the change in policy and its significance both should be reported to those charged with governance. Great. Additionally, we should also report to those charged with governance that the audit strategy and the and the method of auditing, the information required, to audit the properties from next year would also change. Hence, they should be made aware of this fact. But because what happens is this, if you were auditing and requiring a certain type of information every single year for the past like 2 or 3 years, the management knows that this is what we need to provide the auditors, so they will have it prepared in advance before even the audit starts. But let's say the management has changed the properties to fair value. The management knew that you needed this information when you were valuing the properties on cost. The auditors needed this information. They have already prepared this information for the next year as well. And when you go to audit this company for the next year and you require a new type of information, there may be a clash between you and management, that we prepared this for you because this is what you have been asking us, whereas you say, but you change your accounting policy, so we need a new information from you now. So how are you going to stand against that? So you need to tell those charged with governance that this is going to happen. Now we are going to need new types of information, not the old types of information. Your properties are being valued at fair value. IFRS 13 is being applied, IFRS 16 is being applied. At the same time, fair value is being recorded in OCI. So new types of information are going to be needed from you. So they should also be made aware of this fact. That's it for this specific scenario. If I come towards the last one, the board meetings, in a discussion with the audit manager, Violet Corporation's finance director said that he would like the audit engagement partner to attend the company's board meetings on a monthly basis so that he is aware of any issue which may impact on the external audit. What type of issue would this raise? What type of issue does it raise? So basically, the finance director is requesting our audit partner, the partner in an audit firm, that Violet Corporation has a board meeting every month and you should be present in the board meeting. Okay. So before attending the board meeting, maybe the finance director is not aware of the fact that yes, the auditor they can attend the board meeting when they want to. You do not need to tell us that we should attend the board meeting or not. First of all, this is the case. Secondly, the finance director may have this point in his mind that the audit partner has a lot of experience. He will be able to participate in the board meeting and make decisions for the company. Management responsibility. The code of ethics tells us that auditors are not allowed to take management responsibility, and if the partner is being involved in any kind of decision making or he is providing any type of advice, then he is taking management responsibility. So in that case, if the audit team member is being involved in the board meetings, in the board decisions, the resultant threat would be so high that there would be no safeguard against it to reduce it to an acceptable level. Hence, it should be presented to the board that we will join the monthly board meetings, that we can join the board meetings whenever we want to join the board meetings. First of all, the finance director does not need to tell us about this. We are not prohibited to join any kind of board meeting. We don't need your permission for it. But even if we join the board meetings, we will not be taking any participation within decision making or providing you any type of advice within the board meetings. So the board of directors should be made aware of this fact as well. Board meetings, this is the heading that I would provide. I will underline this and move towards my answer. I'll state that the finance director has requested the audit partner to join the monthly board meetings. The audit team is not prohibited from joining the board meetings to be only aware of any issues or discussions that could impact audit, that could impact the audit, but it should also be noted that if an audit team member is involved in decision making in the board, in decision making on the board meetings, or provides any advice, then this creates this means that the audit team member is assuming management responsibility and may also create a self review, not a self review but a self interest threat, because you would not want that board position to be taken away from you. So there is also a reason that's a self interest threat as well. Hence, and there is no appropriate safeguard to reduce these threats to an acceptable level. The board, this matter hence should be reported to those charged with governance. This matter hence should be reported to those charged with governance and explained to them that if the audit partner joins the board meetings, monthly board meetings, joins the monthly board meetings under the request of finance director, this would impair the independence of the partner and audit team. Hence, it should be declined. Basically, what we are trying to say is that we are declining the offer of the finance director because he is telling us to basically perform or be in the monthly board meetings. We do not need to join upon his request. If we are acting upon his request, this surely means that now we will be involved in self-interest threat, and at the same time we will be involved in management threat. We do not need his request to join the board meetings. We can join the board meetings whenever we want. We are the auditors of the company, obviously. So we are declining the request of the finance director, but still we will be involved in the board meeting whenever we want. We are not declining this that we will never come to the board meeting again. We will come to the board meeting whenever we want to, but we will not be acting upon the request of the finance director because this creates a self-interest and the management, right? So this is the question number 1, the part number A, basically the part A of the question, the first 2 parts of the question. Now let's move towards the part 3 of the question, the part B of the questions. What it says is that, yes, critically appraise the key audit matters, extract from the auditor's report on the financial statement of Branson Corporation for the year ended 31st March 2015. Basically, we do not have to identify what opinion we have to provide. That is not the question here. The question is, we have been given the audit report, a small portion of the audit report, and that small portion is the key audit matters itself. Now we need to identify why this is wrong. We need to critically appraise the key audit matters. The question is for 8 marks. I need to identify 8 good points against this to score the 8 marks. That's it. Now, if I come towards the exhibit number 2, if I come towards the exam itself, this is the exhibit number 2. Obviously, I've copied and pasted it within my own software. So we would solve the question from here. We have to critically appraise this report. But the question, the exhibit number 2 states that the audit work for Branson Corporation is complete and the auditor's report is due to be published next week. All right, great. This is the company that we were auditing and we have completed the audit work, and next week we will give the auditor's report. From reviewing the audit working papers, you are aware that Branson Corporation is facing some cash flow problems. So basically we have a lot of cash flow problems. We don't have enough cash with us right now. So this creates a going concern issue over the company, that the company might not have enough cash in the future to continue in the foreseeable future. Now, I will have to make you guys revise the basic understanding. if the situation is confirmed that the company is never going to continue in the foreseeable future, this means that the company will not be able to continue in the next 12 months. The company will liquidate, close. This, if it is confirmed, then the company needs to prepare their financial statements on breakup basis. What are the breakup basis? How are the financial statements prepared on the breakup basis? You don't, that is not under your syllabus. But understand this. If it is confirmed that the company will not be able to continue in the foreseeable future, this means that the company will not be able to continue to do business in the next 12 months. Within the next 12 months, the company will be sold, it will be liquidated, it will be closed, it will be bankrupt. If it is confirmed, then only then the financial statements are made under the breakup basis. If the going concern issue is confirmed that the company will be liquidated, the company will not be able to continue, then the breakup basis is the one upon which the financial statements are prepared. But if it is not confirmed, there is like 50% surety that the company might not be able to continue, might not be able to, or there are less chances, like there are some chances that the company will not be able to continue in the future. It is not confirmed that, but there are chances, just small number of chances, or the company might not be able to continue. Remember the words, if it is confirmed, that is a separate thing. We are dead sure that the company is not able to continue, that the company will not be able to continue in the foreseeable future. But on the other hand, I'm trying to say is that it is not sure. The company just might not be able to continue in the foreseeable future. We do have cash flow problems, but we are going to receive a loan from the bank. We have signed it. So yes, there are cash flow problems, but we know that the company might not be able to continue. What if we don't receive the loan? What if our parent company does not give us cash if we go bankrupt? Because if we are getting support from our parent company, this means that yes, there is a cash flow problem, yes, there is a going concern issue, but we will receive cash from our parent company, we are going to receive the loan from the bank. So this creates the assessment of might, the company might not be able to continue. So now there is a going concern issue, but it is of a less intensity. The going concern issue is of a less intensity. And if the going concern issue is there, but it has a less intensity, what do we do? What the company does itself is that within the notes to the financial statement, or in the disclosure notes, it discloses this fact that we do have cash flow problems for now, but we will receive cash from the loan from the bank. So then we won't have any more cash flow problems. Our going concern issues will be resolved. This fact should be disclosed within the notes. The proper explanation should be given in the notes that the company, we do have this issue for now, but it will be resolved in the next 12 months. There is a material uncertainty over going concern. This means that there is a material uncertainty. What is meant by the word uncertainty? That we are not confirmed. There is an issue relating to going concern, but it is uncertain. We know that we will be able to continue. There is a high chances that we will be able to continue, but still there is a going concern problem. So now we only need to disclose it in the notes. We need to provide a disclosure and explanation that the company is facing. I'm talking about the notes to the financial statement, nothing in the auditor's report for now. So we only need to disclose it within the notes. And if this material uncertainty relating to going concern has been appropriately disclosed within the notes, the company has given appropriate disclosure that we are facing any kind of issue, but will be resolved because we will receive loan from the bank on this date. So we will be able to continue in the next 12 months. If this proper explanation has been given, now as an auditor of this company, it is my responsibility to add a paragraph within my auditor's report. The name of that paragraph is Murgha paragraph, M-U-R-G-H-A, Murgha paragraph, or the full name is material uncertainty relating to going concern. HA is just something I add to basically make it a word. It is known as the Murgha paragraph. So what this means is that now, if the management has given the appropriate disclosure, if the appropriate disclosure has been given by the management that we have the going concern issue for now, but it will be resolved, this means that the auditor only needs to add a Murgha paragraph. Within this paragraph, within their audit report, they will add a Murgha paragraph. Within this paragraph, they will state that the company is facing this issue. We have audited the company and the company has made appropriate disclosure in these notes. The auditor will, in his own audit report, the auditor will refer to the disclosure made by the management in the financial statements. The auditor will just explain in a few words what the issue is relating to material uncertainty of the going concern for the company. And then finally, the auditor in the same paragraph will state, see, the management has disclosed this appropriately within the notes. Right? So now here you need to add a Murga paragraph. But if in case the management has a material uncertainty in relation to going concern, there is an issue over the going concern status of the company will receive cash or whatever the case is, the company will be able to continue in the foreseeable future, the company is sure. You have told the company to make the appropriate disclosure within the notes and the company disagrees with it. The company says that we are not going to make any kind of disclosure. So now no disclosure has been given by the company. The company's financial statements are misstated. This means that you do not need to add the Murga paragraph. The Murga paragraph is only added within the auditor's report if in case the management has appropriately disclosed the going concern uncertainty within financial statement. If the management has not disclosed any kind of going concern uncertainty within the audit report, within the financial statements, this means that now the financial statements are misstated. Now we need to change our opinion. Either it will be an adverse opinion or a qualified opinion, depending upon the situation. More probably it will be a qualified opinion because only one disclosure is not appropriate. Remember, if there is a material uncertainty over going concern and the management has appropriately disclosed that material uncertainty over going concern within the notes to the financial statements, the auditor will add a Murga paragraph. He will not modify his audit opinion. The auditor will add a Murga paragraph. Within that Murga paragraph, he will give the explanation why there is a material uncertainty and how the company will assess it, and refers to the disclosure notes given by the company regarding the material uncertainty relating to going concern. But if there is a material uncertainty over going concern status of the company and the management has not disclosed it appropriately within the notes, this means that now the financial statements are misstated. There is no disclosure, so the auditor will not give a Murga paragraph. Rather, he will modify his audit opinion. All right. So these are the basic understandings relating to it. And we have identified this issue from the cash flow problems. A letter of support has been obtained from its parent company, Grantham Corporation. This means that basically B Corporation, the company we are auditing, is facing some type of issue relating to cash flow problems. What is meant by the letter of support? Letter of support means that Grantham Corporation will support their subsidiary Branson Corporation under every case. This means that they will pay money to Branson Corporation when they need it. If they have a lot of serious cash flow problems and the company is about to liquidate, they are going to pay money to Branson Corporation or support Branson Corporation by in any means possible. This means that they are not going to let Branson Corporation liquidate. So this means that for now, there is a material uncertainty over going concern that the company has cash flow problems, but it will be resolved because whenever Branson Corporation needs money, the parent company is going to give them a chunk of it. The company is going to send a helicopter full of money to Branson Corporation. So there is a material uncertainty on it going concern. It is not confirmed that the company is going to liquidate. Whenever the company is close to liquidation, Grantham Corporation is going to jump in, the parent company is going to jump in and give a chunk load of money to B Corporation whenever they need it. So they are never going to allow B Corporation to liquidate. This simply means that there is a material uncertainty. They are having cash flow problems. They may not be able to continue in the foreseeable future. But whenever they are close to liquidation, the company will never liquidate because G Corporation, the parent company, will give a chunk load of money to Branson Corporation. So basically, there is a material uncertainty over going concern. Now, under this condition, the management of Branson Corporation needs to appropriately disclose this fact that we have a material uncertainty, blah, blah, blah. And whenever we are close to liquidation or whatever the case is, Branson Corporation will support us. Okay. So this disclosure is being verified. So management needs to add this disclosure within their financial statement. And if they properly add the disclosure, the auditor will add a Murga paragraph within their audit report and state that this is an issue, but you can check the disclosure notes as well. There is no going concern, long-term going concern problem. The company will be able to continue, but there is a material uncertainty. And if the management does not add this disclosure, this means now the auditor does not need to add the Murga paragraph. Rather, they will modify their opinion. The audit working papers conclude that there is a significant doubt over the company's going concern issues, going concern problems again mean there is a material uncertainty, and that the financial statements of Grantham Corporation have been reviewed to confirm its financial status and ability to support Branson Corporation. All right, great. The notes to the financial statement describe the cash flow problems faced by Branson Corporation and support offered by Grantham Corporation. So the management has disclosed this fact in the disclosure note to the financial statements. Good. Now we only need to add the Murga paragraph in our audit report. The audit working papers conclude that the disclosures made in the financial statement are complete and appropriate. Great. A draft of the key audit matters section of the auditor's report in respect of Branson Corporation is shown. Now, this is our auditor's report. This is what we have done. What have we done? We have done nothing. We have done a big blunder, according to what I see. Under the key audit matters paragraph, we have included a paragraph going concern issue, and we have stated that we draw your attention to the going concern problems faced by Branson Corporation. The company is loss making for the third consecutive year. The going concern problems are fully described in the operating financial review, which accompanies these financial statements. We are confident that the parent company Grantham Corporation is fully able to support Branson Corporation. This information was to be included in the Murga paragraph, not the key audit section. The key audit section contains only the issues that we faced in the audit or the financial statement items that were very significant and how we audited them. The key audit matters do not include going concern issues. The key audit matters, this paragraph was to be included within what? Within the Murga paragraph within the auditor's report, and that is not the key auditor's matter. Key audit matters. So this is the number one issue that I have identified. So before moving towards the question, I will state part B, give the heading, bold it. The number one issue I will simply state, because there are two types of, okay, let's just go with going concern and explain each thing within line by line. CONCERN. In a paragraph format, I'm going to explain. Kindly ignore the spelling mistakes, please. Okay, coming towards it, the auditors have included the going concern issue within the key audit matters. Now I need to explain what the actually key audit matters is for. Key audit matters, key audit matter paragraph is only used when the company is listed and if the auditors identified significant issues and also to disclose how the auditors audited these issues. This is what the key audit matter paragraph is used for. Hence, the going concern should not have been disclosed, should not have been included within the key audit matter paragraph. Rather, a separate material uncertainty to going concern. I'll need to like separate it out as separate. Let's give it some common commas. Material uncertainty related to going concern paragraph should have been included. Let me show you the notes where the matter is included. Let me show you the notes where the matter is actually included. If I come here, let me show it to you within the notes themselves, auditor's report notes. Right here. If you see here within the syllabus area, the notes that I provided to all of my students, this is where this issue is included. If you are adding a Murga paragraph, it is included right after the basis of opinion paragraph. So I'll need to mention this again. Coming towards the question, paragraph should have been included right after the basis of opinion paragraph, and the going concern issue should have been discussed in this paragraph. Now, obviously, this is not the only issue that I identified. Within this paragraph, which I studied, there are also other issues as well. For example, the company is loss making for the third year consecutively. Why are you stating it is loss making? The company is not. When you're talking about going concern issue, you are not looking at the loss. You are looking at the cash flow problems. The company is having material uncertainty relating to going concern because of cash. You can't say that it is loss making here. You need to state that company is facing cash flow problems. So this is also an issue which I will state here. Additionally, instead of stating that the company is making loss for the past 3 years, it should be stated that the company is facing cash flow problems because now I also need to state the fact here that the going concern issue has not arisen because of loss. It has arisen because of cash flow problems. So I will state it here because the going concern issue has risen because of the cash flow problems faced by the company, faced by Branson Corporation. I'll write down the full name of the company. This is the second issue that I identified within this paragraph. If I come even forwards and the going concern problems are fully described in the operating and financial review, what is meant by this? I told you guys right here when I was stating it, within my Murga paragraph, I will have to refer to the disclosure notes where the disclosure has been made for the material uncertainty by the management. Here you are referring to some kind of operating and financial review. No, you need to and are fully described in the, you are referring in the wrong place. You need to refer it to the disclosure notes. I'll also mention this. Within the paragraph, we have also referred to the which area? To the operating and financial review area. Operating and financial review area. Whereas this is not the place to refer for going concern issue. According to the code, the auditor should refer to the disclosure made by the management for the material uncertainty relating to going concern. The auditor should refer to the disclosure made by the management for material uncertainty relating to going concern. Hence, this referral is not correct and should be amended. That's it. I think I have also missed something out, but let's talk about the next thing first. Additionally, I'm stating that, here we are stating that we are confident. Why are you stating within your audit report that as an auditor, I am confident that the parent company will pay? No, you can't state. No. This means that in some way you are promoting the client now. In some way you are stating that we are sure of it. Even though this also within the what was that area? Professionalism, ethics and professionalism. Within professionalism, we studied about MAP, right? The first M stands for money laundering. The second A stands for auditor's liability. Now, within your audit report, you are stating that we are sure that the parent company is going to pay B corporation money whenever they need it. What if they don't pay in the future? The user of the financial statement will come running towards you and say that as an auditor, you said this, so I'm going to sue you. You have said this within your auditor's report. This will increase your future liability. You cannot include this here. So this is what I need to state. At the same time, we have stated that the parent will surely support Branson Corporation whenever they require this statement should not be included for the fact that this increases our liability towards the users in future. If the parent of Branson Corporation does not support them, the users may sue us for this statement in the auditor's report. Hence, this statement should be removed from the auditor's report. That's all I need to add here regarding this issue. Additionally, I did not add, I forgot about the case that I had to explain the auditors have included hence the going concern issue should be disclosed separately. I need to include here why we need to add a Murugha paragraph. I haven't included it. When a management has made appropriate disclosure regarding the going concern regarding uncertainty relating to going concern, and that disclosure is complete and appropriate, the auditor should include a Murugha, not a Murugha paragraph. I cannot write Murugha within the exam. This is just the short form to memorize this paragraph's names. Material uncertainty relating to going concern, paragraph, GRAPH, paragraph within their auditor's report. Oh, within their auditor's report. As what is the name of our audit firm? The name of our audit firm was, I forgot the name. I forgot the name of the audit firm. Wait a second. Crawley and Corporation. As Crawley and Corporation has identified that the disclosure is complete and appropriate. Hence, this paragraph should be included within the auditor's report. That's it. That would have been my introduction towards this, and finally I would go towards each of the issue one by one. Now coming towards the next issues, obviously there is another paragraph right here which they are adding within, where is it? Right here, they are also adding something else within the key audit matters paragraph. Let's discuss about that as well. Now within the CAM, I have also included a second issue, that is obviously now I need to remember what is included within CAM, the significant issues that are identified and how I dealt with those. And it just like the way you identify audit risk, just like the way you used to identify audit risk and gave a recommendation against it within F8, not in AAA. You do not provide a recommendation within AAA. You only identify the audit risk. But F8, what you used to do, you used to identify the audit risk and give a recommendation against it. So the significant areas where the risk was very high, or the significant issues that you faced during the audit, you mentioned those and how you audited those areas. This is what you mentioned within key audit matters. Now keep this in mind. In the second thing, contract win. On a more positive note, we are pleased to announce that Branson Corporation has recently been successful in tendering for a significant new contract to supply Talbot Corporation with pharmaceutical goods. All right, we are stating that our company that we are auditing is providing, it has won a new contract. Great, but we should not have done this. But let's read it first. The tendering process was very competitive, and the management team of Branson Corporation was pleased to win the contract with Rose Corporation, a key competitor. We believe that this will return Branson Corporation profitability to next year and eliminates the going concern problems to a large extent. First of all, this issue is not a significant issue, first of all. And at the same time, I have not provided how I dealt with this issue. So this issue itself cannot be done, cannot be included within CAM. This is the first thing that I will state. Let me give the heading of contract when I need to underline this and underline the above one as well. So now I'll go ahead and state that according to the definition of CAM paragraph as discussed above, this issue does not, where have I discussed the CAM above? Right here in the first paragraph, right here. So I do not need to mention it again. According to the definition of CAM paragraph and as discussed above, not and. This issue does not fall under the definition of CAM as we have not identified any significant issue, neither provided any information of how these were audited. Hence, this should not have been included within CAM. The second issue that I identified as I was reading this is that above, in the above portion, you are stating, and at the same time within the Murgha paragraph, you have stated that there is a material uncertainty relating to going concern. In the second paragraph, you are contradicting with your own statement that you gave above. An auditor's report should not be contradicting with each other. You have already given an opinion upon the Murgha paragraph, in the Murgha paragraph over the material uncertainty, and here you are stating that because of this new contract that we have obtained, we will be able to go into profitability again. So you are stating that the above issue will be finished in the next year. You can't do that. You are contradicting with your own information, so you cannot state this line right here. You cannot state this line. So coming towards my answer, I will say additionally, the auditor's report, the auditor's wording regarding again going to profitability and what was the line? And elimination of going concern, elimination of going concern contradicts with their own opinion on going concern provided earlier. An auditor's report should not have contradicting evidence. At the same time, as we have already provided an opinion earlier on going concern, hence this fact of elimination represents another opinion on going concern, hence this opinion should not be provided within the auditor's report. This is the first issue that I identified. Now, if I come towards the second issue, you are stating a competitor's name of the company. Why? Who has given you the allowance to say that Rose Corporation is a competitor to Branson Corporation? It is very unprofessional to say the name of a company's competitor that you are auditing. You can't do that. So this is also a big issue that you have stated here. Within the auditor's report, I have again pressed the wrong button. Within the auditor's report, we have stated the name of the competitor of Branson Corporation, writing the full name, Branson Corporation, it is highly unprofessional to state a name of any company related with audit client within the auditor's report. Hence, this should not be included. This should not be included. That's it. If I come towards the third issue, up till now, when I was talking about this one, I used to say that this paragraph should be added in a separate paragraph, that is the Murga paragraph. But whatever I'm reading here, this shouldn't be added, this shouldn't be added, this line should not be even added. So I think the whole paragraph should be removed. Obviously, the whole paragraph is to be removed. First of all, this should not have been included within the key audit matter paragraph. Again, why are you taking so much side of the client here? What I'm saying is that you are like trying to hug the client that, oh, we are so like pleased that you will be able to continue, you will be able to get yourself out of these going concern problems, you have won a new contract. Why are you doing this? Why are you taking sides with the client? This, I think, these lines that you have stated above, we are pleased to announce that Branson Corporation had recently been successful in tendering and blah blah blah, this shows that now you are taking sides with the client and you are impairing your own objectivity, because the definition of ethics, the definition of objectivity, the fundamental principles ICOP square within ethics used, the objectivity states that you should be neutral, you should be unbiased, you should not allow conflict of interest or undue influence of others to override your professional or business judgment. Here I see that you're not, this specifically shows that your objectivity is impaired, you're not anymore neutral because you're trying to take the side with the client. Hence, your objectivity is impaired. So, this whole paragraph now should not be included within the auditor's report. This whole paragraph should not be included at any level within the auditor's report. Neither the key audit matter paragraph, neither the basis of opinion paragraph. This paragraph should not be included anywhere. But obviously, I just can't say that this whole paragraph should not be included. I need to describe each and every point line by line. So, coming forwards, now is the time to state. Additionally, the statement that we are pleased, the statement that we are pleased would create an impression to the users that we are taking sides with the client or trying to promote their position in front of the users. This would mean that our objectivity is impaired, and hence we did not follow the code of ethics during the audit, and hence may lead to severe consequences as a result of this whole paragraph. Now I'm going to go towards the statement that this paragraph as a whole should be removed from the audit report as a result of this paragraph. Hence this whole paragraph, slash whole statement regarding the new contract should not be included within the auditors. Kindly ignore the spelling mistakes. Auditors report. That's it. That is all I need to do about this question. And I guess we are done with this question as well. So we are done with March-June 2023 exam. First, we solved the question number 1, in which the major portion was the audit risk and then some other parts as well. There was a technical part there as well, a difficult part where we had to identify why such matters should be included in there. Then we came towards question number 2, and then we have completed the question number 3. If you have any questions or something that you still don't understand, you can ask me anytime you want to. If you want the notes to these questions, you can contact me as well. The notes, obviously, these are the notes that I have written, the answers. If you need these answers that I have written, you can ask me also for these. You can contact me for those. So thank you all. Take care and bye-bye.